This article, Old, Frail, and Uninsured: Accounting for Puzzles in the U.S. Long-Term Care Insurance Market, provides a "quantitative equilibrium optimal contracting model of the long-term care insurance market that features screening along the extensive margin." This model shows an insurer deciding which risk groups to offer insurance to. It also goes over the comprehension and pricing of coverage for the risk group that is insured. Long-term care insurance market shows that insurers have information that the individuals who are at risk do not have, and it also shows insurance denials. Many individuals have private information about their nursing home entry risk, and this private information has an important effect on whether an individual is offered insurance and if they are denied coverage. This is important because an individual's risk exposure impacts their insurance arrangements. Those individuals who believe that their risk of nursing home entry is high, they will be more likely to purchase long-term care insurance. Half of U.S. 50-year-olds will stay in a nursing home before they die and incur very expensive out-of-pocket long-term care expenses. At only a low number of 10% of individuals over 62 years old will have a private long-term care insurance. Insurance companies have to set limitations on who they can provide services to, because they can't offer it to everyone. Unfortunately, this means that they are leaving out individuals who need or could benefit from their service. Individuals who categorize themselves in the frail or poor risk group that are offered a single contract of no insurance are considered rejections. These rejections are the main reason that long-term care insurance has a low rate of people who are eligible of this insurance. Long-term care was designed with the elderly in mind. Though that's not a bad thing, it just leaves out younger individuals who also need the services that long-term care provides. There were surveys conducted that concluded that 20% of long-term care insurance applications are rejected by underwriters. An underwriter is a person or company that signs and accepts liability under an insurance policy which guarantees a payment in a loss case or if damage occurs. After applying industry medical guidelines to the health and retirement study data, it is found that about 50% of individuals that applied for long-term care insurance coverage that were between the ages of 55 and 66 were rejected. Another test was conducted where an insurer offers two contracts to a group of risk-averse individuals, but they have two different private risk exposures. The first contract offers full coverage and the second offers partial to no coverage at a lower premium. The individuals at high risk selected the first full coverage contract, while the individuals who were at a low risk selected the partial coverage contract. This becomes a major burden on people because the individuals who need the most care struggle to afford it and have the constant worrying of not being able to qualify for it. Medicaid and administrative costs both publicly provide long-term care insurance. If Medicaid offered generous benefits, there would be no basis for trade, which then means there would only be an option of a single contract that provides no coverage to the entire risk group, high and low risk individuals. Similar to Medicaid, administrative costs would have no basis for trade if the reduced profits from insuring a given risk group were large enough. When Medicaid and administrative costs are present, the optimal coverage would be partial coverage, even for high-risk individuals. This is because if a high-risk individual is uncertain if they will qualify for a nursing home entry, they would prefer a partial coverage contract to a full coverage contract. In the end, both partial and full coverage contracts exhibit partial coverage. Medicaid produces higher rejection rates among individuals who are considered poor because they are more likely to qualify for Medicaid benefits. Administrative costs result in rejections of frail risk groups because they are also typically poor and have a higher dispersion in private information. Removing private information would increase the coverage of both types of risk groups. Also, reducing the scale of Medicaid would also increase the level of coverage for both types of risk groups with private information. If Medicaid was not present, low and high risk types experience lower coverage and a decline in the load they receive. So, the overall conclusion of these surveys and models are rejection rates decline with wealth, long-term care insurance's high cost is an important reason for low take-up rates, and Medicaid is the most important for accounting for low long-term care insurance take-up rates among the poor. Our textbook, Delivering Healthcare in America, correlates with this article in many ways. The textbook states that Medicaid requires an individual to spend down their assets to poverty level for them to qualify for long-term care coverage. Many middle-class people worry about their ability to pay for the care and do not want to face the high risk of needing long-term care in their retirement. The cost of long-term care will potentially make an ongoing dent into an individual's income and savings, which would change their standards of living. When the Long-Term Care Insurance Partnership Program was created by the DRA in 2005, individuals who purchased private long-term care insurance were able to hold a part of their finances for when they become eligible for Medicaid benefits. Overall, there needs to be changes to these policies because Medicaid costs for long-term care are unsustainable in the long run. Many lives could be improved and individuals could receive the care they actually need, but long-term care just seems to only be looking out for themselves and not the people who need them. And here are my references.